What up, team? What up, family? What up, world? It's your brother, Dr. Curry. And today we're going to do something exciting. We're going to embark on a journey into the Forex world of trading, specifically today, focusing on risk management. And this is for beginners and advanced traders. Now, let's go. First thing I want to do is I want to really set this stage for what we're about to be talking about. Today is specifically for risk management in the Forex markets. We're going to be maximizing our opportunities. Today, I'm going to show you how to really maximize every single signal that comes out, every single trade that you take, so you can literally be in and out of this global currency within the markets. Now, we're talking about a dynamic field that can seem daunting at first, but with the right approach, it can be both rewarding and manageable. Yes, manageable. We'll be focusing on three main pillars: understanding risk management, seizing the market and opportunities, while also developing a disciplined trading strategy. Today, my goal is simply to help you grasp the fundamental concepts that will serve as the foundation for your trading success. Remember, effective risk management isn't just about minimizing losses. It's about positioning yourself to take advantage of market movements. We had some decent movements this morning in the market. I want you to ask yourself, did you take advantage of what happened, what was presented in today's market? Now, as we move forward, I want you to keep an open mind, have your pen, have your pad, and I want you to be able and be ready to engage with the content that I'm getting ready to deliver to you guys, to take those notes and really apply it to everything that we're doing. Now, the world of Forex trading, and why is it such a compelling market? Let's be real. I want you guys to consider this. Forex is the largest financial market globally, with a staggering daily turnover of about $7 trillion. I say $7 trillion. It's a market that doesn't sleep because trading happens 24 hours a day, 5 days a week. Now, what sets Forex apart is its flexibility. You have the ability to profit whether the market is going up, the market is going down. You can just really adjust your position and size from either micros or even larger lots, which is a standard lot and higher. This flexibility allows you to manage your risk more effectively than in stocks or crypto, especially with the tight stop losses that we do here. We believe in a Forex approach that a simple structure and a simple structure and that it's repeatable. The focus is to focus on small control moves that can explode into massive trades with a super tight risk. Kind of like what I do with my 90-10. I risk 10% to gain 90% in the market. Now, how many of you guys would love to risk 10% to gain 90%? Well, when you're doing things the right way and you're doing the proper markups and you have your structure, everything's in a line, you can take advantage of those type of opportunities because you see them before they happen. And when that opportunity presents, you hop on it. See, this is not about gambling or guessing. It's about trading with precision, trading with consistency, trading with confidence. Say it with me though. Precision and constant consistency gives you the confidence to see that big move to take advantage of it. The methodology teaches risk before reward. I want to emphasize on using tight stop losses with a clear invalidation point. See, when you know that the goal is to focus on the high probability setups and scale your lot size responsibly, this approach builds confidence through repeatable execution. Now, let that sink in. In essence, we see trading as a structured skill set. It's about controlling risk, not chasing hype. Now, let's really dive into this. I want you guys to look at this screen real quick. Steps for success. See, the key to success in Forex trading is precision and consistency, not gambling. The approach is all about building confidence through structure. We focus on controlling the risk with the tight stop loss and trading and taking advantage of high probability pressure setup. See, when you do this, this ensures that you grow your account, let's just say that we grow our accounts and to something that's so massive with even a higher lot size with the proper responsibility, we don't have to chase the big pip moves because we're working on consistency. We're working on structure. We're working on precision. We're not gambling in the market. And I'm going to tell you this, if you're trading with a smaller lot size, you're doing yourself a disservice because you can have A1 setups, but if your lot size is not appropriated correctly, it's like you've never even taken the trade. See, your edge in trading comes from discipline, risk control, and repeatable execution. This means taking a small risk and using proper sizing to achieve minimal, meaningful results. Remember, your job isn't to win big, it's to trade well. We take what the market give us, like our coach Dr. Bethany said, we're gonna take that little change. We take what the market gives us. We're gonna take that little change. I say again, we take what the market gives us. We don't force trades. We don't force trades, guys. We see what the market is doing and then we hop on it. We know where we're going in the market. We put our stop loss in the profit. So no matter what happens in the market, you win in that trade. See, by maintaining discipline and focusing on structure, high probability setups, we can achieve sustained success in trading. Now, let's explore something real quick, and I want you guys to look at this. This is a chart that's actually in our 220K as a trade that I actually put out there to you guys. See, this right here is structured. It's a beautiful approach to trading, but let's really dive into this a little bit deeper. See, our direction is a buy. We're looking to buy this trade, guys. And we had an entry at 207.646. A stop loss is placed at 207.584. That's just 5 pips away, assuring our risk is tightly controlled. So if the market goes away from us, if it goes in the opposite direction, we minimize how much we actually lose in the market. See, we aim to take profit of 6 pips for this type of trade right here. Once we're up by 4 pips, we lock in 2 pips using the trailing stop method, the trailing stop rule. This method allows you to secure profits while still giving your trade room to grow. And then at this time, if you wanted to, you can increase your TP a little higher to let that trade run. Guys, listen, every trade we enter is meticulously planned before any money is risked. This planning is crucial as it gets. It keeps our risk small and manageable. I say it keeps our risk small and very manageable. The key feature of this approach is the simplicity, the control, and the repeatability. By maintaining these principles, we ensure that our trades are executed professionally. This sets the stage perfectly for understanding why this trade works or why it didn't work because we're managing everything that we're doing. Now, I want to dive into this right here. Let's this right here is starting at $1 or let's say 1.00. That's a standard lot for you guys. This is all about Forex. This is not about futures, but I want to show you guys how powerful with increasing your lot size to really dominate in the market in a less amount of time. A lot of you guys were on the last call that we did on the nightclub when we were trading Forex and it was bouncing in between those zones. I had a higher lot and I was just taking what the market was giving me. See, the key here is precision with high accuracy and minimum risk. When we start with the lot size of one standard, we maintain control over our trades. And here why this method works so well. Consistency. By using the same setup, and the same stop loss every single time, we create a repeatable process. This helps in managing risk effectively. See, small targets, big impacts. Even though our PIP targets are small, they still yield significant results. See, the beauty is in the precision. Less time in trades means less exposure to potential market volatility. Efficient profit locking with easier trailing and securing of the profits. They are less emotional. less strain, making the execution a lot cleaner and more focused. See, starting at a standard lot isn't about aggressiveness. It's about being strategic. For Forex pairs, this approach ensures that risk is predefined and limited. Remember, our model thrives on tight stop losses and controlled moves. This structure this structure allows discipline. It's what allows us to manage our risk first and let our lot size do the work for us. This right here, understanding pit value, this right here is the key. This is very crucial for a successful trading strategy. Now, I want to dive into why this is the key concept that can unlock your potential as a signified trader here in this market. Now, some of you might be asking yourself exactly what a pip value is. Simply put, it's the measure of the smallest price movement in the market. Understanding it allows us, honestly, to accurately calculate potential profits and losses. This is especially important for funded traders like ourselves or individuals that are looking to pass a funded account, as it informs our decision and ensures we measure our accounts responsibly. Remember, knowing your pit value isn't just a technical detail, it's a foundation for making informed trades. By grasping this, you'll be able to identify opportunities and risk with greater precision. Now, as we move forward, keep in mind that mastering pit value is not just about numbers, it's about gaining the confidence to execute trades with precision and control. Now, let's explore this concept a little bit farther and see how this applies in real world scenarios. So, on the chart, I have a graph. We're looking at GBP, JPY, looking at taking a one standard lot position on this trade. At one standard, that's $9 per pip. And I want you guys to look if we were to increase. So if I was trading 1.00 per pip, that's $9 per price movement. If I decided to do 5.00, that's $45 per pip. And 6 pips, that's about $54 per pip. So I want you guys looking at this. We're not talking about how much the market is going to go, if it's going 10, if it's going 30. No, no, no. We're talking about each movement in the market based on your lot size is what you will achieve based on this. Now, the system uses small moves with high accuracy because risk is tight. Our risk is very, very tight. The stop loss is very, very tight. But that right there is what allows us to have the advantage in the market. See, when we start at 1.00, a standard lot size, in and on the forex markets, because the risk is already predefined, that's not being aggressive, that's being smart in the market. That's allowing us to see how much we can lose or take a lesson in the market if the market decides to go the other way. See, that's what you must be comfortable with when setting up your stop loss. Are you comfortable if this trade goes the other way? Are you okay with losing that much money in your account? If you're not, then you need to decrease your lot size. But see, here's the caveat to what we do. With trading a standard and higher, our stop loss is so minimum, so small that the drawdown is very minimum. But the reward to the risk is so much more better. Now, the key concept is income is controlled by the lot size, not pip count. So on GBP JPY, what we have here, the one pip is $9, and small moves can play very well. So if we're going for 5 pips, that's $9 times five. If we're going for 10 pips, that's $9 times 10. So that's how you can gauge how much you're looking to make in the market with using these type of scenarios. So here's something real quick. So 6 pips to get you $54. 25 pips will get you $225. 50 pips will get you $450, and 100 pips will get you $900. Now, the reason I use these numbers, because this right here is basically the very first trade that comes out, what we're looking to gain in the market. But every single trade that I throw out there, automatically, I'm looking to gain 25 pips, 50 pips, and 100 pips based on that move that is dropped in that market. Now, guys, strategies and educators for success. You guys must plug into the academy. You guys must learn the verbiage. This is how you become a better version of yourself. This is how you become a better trader. Go ahead, plug into some of these educators, find out which educator best suits you for trading the gold and any of the other Forex pairs they may be, and then learn how they trade, learn their lingo, learn their verbiage. So when it's time for you to push the button, you're ready to execute. One of the biggest misconceptions when it comes to trading is people or individuals think the trade went the opposite way, but that's beyond the truth. What really hurts a lot of individuals when the setup is there, they see the setup, but they don't believe the setup, so they don't execute immediately on the setup. They're hesitant. So when you're hesitant, that causes you to lose money in the market because you're not in the market. The market is moving without you. So then when you potentially get into the market's in a small pullback, you get a little bit nervous, you close the trade, and then the market goes in your direction. So I say that to say this: let the trade play out, let the trade do what it's going to do. If you're going to enter the trade, already know where your stop loss is, enter the trade, enter the trade. Take the trade, people. Take the trade. Now, this right here, why higher lot size is the advantage. We've already went over that a little bit, but let's dive into it a little bit more. Small moves still pay well. You don't have to go for 300,000 pips if your lot size is right. There's no need to overstay trades. So if you're in a trade and you're starting to feel a little uneasy, a little nervous, get out of the trade and look for another setup, guys. It's easier to trail and lock profits, less emotional decision making, and more consistent income potential. That's what makes trading higher lot size even better. Now, I want to shift into a mindset real quick. The pips aren't the capital, the size is. Now, if we're all retail traders, but we don't have to have a retail mindset. We can have the professional strategy, the professional mindset. See, when it comes to a retail mindset, they're chasing pips. How many of you are probably chasing pips? You don't have to chase pips. You don't have to worry about the trade. Let the trade play out. We focus on small moves endlessly. Take the trade. Let it do what it do. Don't be in and out, in and out, in and out, closing with a loss, closing with a loss. Focus on the small moves, let it do what it do, then come back. Think about risk after it's a problem. That means entering a trade, not putting the stop loss in, and then you see the trade go into profit. You still don't have a stop loss. Say the trade goes up $200. You're in the green, and then the trade pulls back 50 bucks and you're like, it's going to go back up. Then the trade pulls back 150 and you're still in the trade like it's going to go back up. Then the trade pulls back 300. What are you doing? Get out of the trade. See, you don't want to think about the risk after you're in the trade, and because that's when it becomes a problem. You should already know before you're entering that trade how much you're willing to take a lesson on. You should already know that. See, the professional strategists, they focus on size and they secure the results. We already know what lot size we're going for. Everybody, standard and higher, to get the bag and get out. You capture the big moves with patience. You're in that trade. You got your stop loss set. Your trade goes into profit. You see it's a home run play. Let the trade run, guys. And the reason I say that because when some of you trade and you go negative, you hold on to that trade thinking it's gonna come back, and you hold, you hold, you hold. But then on the other side, some of you guys get into a trade, and as soon as it goes into a profit, you're ready to close the trade. Whew. I went into profit $10. Let me take my $10. I'm out. But you were just down 300. Give the trade an opportunity to go up 300 in that trade or whatever your dollar or TP may be. So that's what it means when it says capture the big moves. Define risk before every trade. We're looking at our stop loss, what our stop loss is going to be, where is our structure point every single time before we even enter the trade, because you can literally see the setup before it happens. Now, if you're taking my trades that may be in the virtual campus, the stop loss is going to be there. Guys, put that stop loss in, enter the trade, stop loss, TP. Boom, you're good to go. Stop loss is the most important. Now, let's dive into the foundation of successful trading: structure, discipline. You heard me. Successful trading is structure and discipline. First, remember the mantra: risk first, This means always assessing potential risk before making any trading decision. It's about protecting your investments, protecting your capital, taking your little change whenever you can, and then you minimize the potential losses. And then I want you to focus on structure always. Having a structured plan ensures consistency and helps you stick to your trading strategy, even when your emotions are maybe running high. I know that's some of you on here. And always, guys, always remember results follow by prioritizing risk management and maintaining a structured approach. Positive results will naturally come. It might take time, but patience and discipline pays off. How many times have you guys heard me say, I'm waiting, I'm waiting, I'm waiting, I'm not getting in, I'm not getting in, I'm waiting, boom, let's get in, and she shoots straight into profit. It's the same thing on this side. Once you start to prioritize these principles for a smarter, more disciplined trading journey, you'll put a big smile on your face because of the rewards and the profits you're going to be taking from the market. Remember, the market doesn't owe you anything. But what we do is we dedicate and we make educated, precise moves into the market to dominate the market. Now, education and risk disclosure, I got to say this to you guys. This content is for educational purposes only. This is not financial advice or investment recommendations. Trading involves risk and is not suitable for everyone. Past performance does not guarantee future results. You are responsible for your own decisions. Always trade with proper risk and proper management. One thing I like to say, if you can't afford to lose it in the market, don't trade with it. Decrease maybe. If you can afford to lose that in the market, you're in a good space. Now dominate the market. This right here is an infographic that I have. If you guys want this, just hit me up. Let me know. This is dealing with pips, points, and ticks all the way around. Just a quick graph to show you guys how everything flows and how to calculate certain things and typical sizes and position quotes and things of that nature. Now, why lot sizes matter in Forex, guys? Professionals don't overstay trades. They get in, they get out. They trail their profits. They lock profits in and they stay emotional neutral. The day you can emotionally detach your emotions from trading and the outcome, that's when your trading goes to the next level. So this chart right here is just for you guys to look at real quick, just to show you guys what it's like to trade on different lot sizes. So we have the nano, the micro, the mini, and the standard, and then you have your operation of units. And then we have the volume. So the volume is when we're trading, say we're going 0.001 or we're going 0.01 or 0.10 for minis or 1.00 or 00 for standards. The pip value is showing you how much money you will make off that price of movement in the market. So when you get to the 0.10 and the 1.00, that's when the game really flips. And trading this way with using the proper risk management will really just grow your accounts, guys. I can't put it any other way. So this right here is a quick video I wanted to put up here, guys, just showing you individuals who started their accounts with a $500 account, 1,000 and so forth. You can see it right here. And then with using certain lot sizes, what they would profit. This is the same move, the same pair. They're risking 3% per trade, just going for 30 pip with a 30 pip stop loss. But the risk to reward is 1 to 4. So if we're going for a 1 to 4, we risk 1 to gain 4. These right here are the payouts with these trades. See, the same trade at a 0.05 is $60, but at a standard, that's $1,200. That's a big difference. That's a big difference. So that's why sizing truly matters when we're trading on this Forex side. Now, who is the trading model for, guys? Traders who follow rules, comfortable with tight stop losses, focus on consistency, willing to size responsibly. This model rewards discipline, not impulsive decisions, impulsive moves. That's what this training right here is for. Now, common mistakes to avoid, guys: chasing pips. We don't chase the market. We let the market come to us. Moving stop losses. Leave your stop loss, let the play run unless you're deep into profit. Oversizing without structure. If that's not an A1 setup, number one, don't take the trade. But say you happen to get into the trade, we're not going to bet the whole account per se on that trade. If I'm normally trading three standards on an A plus setup and I see a setup that is not an A plus setup, guess what, guys? I'm not going to use three standards. I'm not going to use five standards. I'm going to lower my risk per that trade setup, or maybe even pass that trade and all, and only take trades that are A1 setups. And then trading without pressure confirmation. Use your validation tools to make sure that that's an A1 setup or even a B setup and take the trade. Do not take trades that do not align with the way you trade. And then, guys, let the size work for you. Small moves, tight risk, proper size, clean execution. This is a skill. It's not a shortcut. Doing this right here will allow you to dominate the market as well, while maximizing your trading opportunities within the market. Now, small moves, tight risk, proper size, and clean execution. Again, be disciplined, size smart, and trade safe. Now you guys already know you can get started in three steps, guys. You know, we get enrolled, we sign up, we activate our account. Those that are new, I want you guys to hop onto the Monday and Tuesday night club, the Monday and Tuesday night calls that we do with Dr. Andre Logic Beffley, the co-founder of Rich University, and myself. We host the night club, and this is where we come and we trade collectively together while also improving the mindset on what to do with the money once you have it, guys. And then we also do the Breakfast Club as well, Monday through Friday. I salute you guys. This is all I have for you. We will do a little bit more in this. I just wanted to put something out there for you guys to put your eyes on, to take your notes, to really think about what you're doing before you get into the market. What I like to say is what you're doing prior to getting into the market. And then we're going to end off with a short video showing you how to do the same thing with the tool that's on Trade Locker, because there's a built-in risk management tool on the platform as well. And I'm pretty sure my brother Dre Lavelle's already went over there. But we're going to end it out here. I salute you guys. Till next time, I salute you. I'll see you on the other side of the TP, because on the other side of the stop loss is way too common.
Use TradeLocker Risk Management Calculator, which is the powerful tool that allows you to easily calculate lot sizes, etc., based on your risk you want to take. Switch to a pending order, and I'll click on the risk icon and activate the TP and the stop loss. Let's say I want to risk $200 of my account. It will auto-calculate the lot size, or how much the position size for this position. You can move your stop loss to wherever you want, and it will adjust the lot size accordingly. No matter where I put my stop loss, I'm not going to lose more than $200. Take the numbers from the signal, just execute buy, and this is a pending order. This is how powerful this small calculation.
So this is really cool because this is showing exactly what you guys can do. You guys get the alerts and the $200 to $20,000 challenge, guys. Take this signal now. Sometimes they may be pending orders, but most of the time my stuff is market execution. So wherever the price is, look at the price and see where it is on that chart. If you have to do a pending order, switch over to pending order, put that number in and go from there. But if it's a market execution, guys, you can go ahead, do the exact same thing, the exact same risk analysis, and dominate within the market. It's your brother, Dr. Curry. I'll see you guys. We out of here. Let's go. Drop a like or a comment on this video if you found value in this video. Let me know your feedback.